Hello everyone, this is Business at 9. I'm Shibani Gharat, and now in the shifting geopolitical landscape where concerns about Trump's tariff still persist, what kind of growth is likely for the Indian market? How are Indian equities valued compared to other emerging market peers, and by when can we expect a steady return of FII flows into the market? To discuss all of this and more, we have with us Venkatesh Balasubramanian, MD and Head of Research, JM Financial Securities. Venkatesh, welcome to ET Now. Well, the earnings have been steady. Market has already priced in tariff uncertainty. Nifty above the 26,000 mark. Which trigger will now help Nifty scale fresh highs?
See, firstly, I don't think the Nifty is going to scale fresh highs. So you are looking at a sideways market, at least for the next 6 months. We need to remember that the market is expensive at 23 times FY26. You could have still justified these valuations if you were going at 15% or 20%, which the Nifty earnings are not growing at those kind of levels. In FY25, Nifty earnings grew at maybe 3 or 3.5%. Current year, we're most probably going to end up in maybe with 8 to 9% kind of growth. So with those kind of earnings growth, it's very hard to justify higher valuations than what you're getting today. So our own belief, this has been our belief for the last 12 months, that the market is basically going to move sideways. There will be a time correction, and it is exactly how things are playing out. I don't think the setup has changed any way on the positive side, at least for the next 6 months. We will be in a sideways market. You will continue seeing FII selling, and you will continue seeing the domestic mutual funds absorbing a lot of that flow. So the market stays sideways is my view. As we get into the new year, that is maybe once we move into say April 26 odd, the market will then start looking at the next year numbers, that is FY27 numbers. Now, FY27 at this point in time looks like a much better year in terms of earnings growth. We believe that 15% plus kind of growth is possible. One, because private sector banks, which is almost 30% of the Nifty, the numbers will change next year. We are expecting 11 to 12% kind of loan growth. We are expecting a little bit of NIM expansion next year from the low base of the current year. So you could see, let's say, 12 to 15% growth on the bank side. There has been an income tax cut. There has been a GST cut over the last 8 to 9 months. Third quarter onwards, you will start seeing an impact on demand. Demand will look much better. Going into next year, we believe auto numbers will get revised upwards. We also believe FMCG numbers will get revised upwards. So with consumption and banking firing next year we would definitely be much more constructive than what we are at this point in time, at least for the current year.
Venkatesh, also since you just concluded your 2-day conference, what is the sense that you are getting from India Inc.? What are the management suggesting?
See, we are just almost maybe in the next hour or 2 hours, we'll be closing our conference. We've had a fantastic 3 days. We've had 200 corporates attending our conference. We've had between 750 to 800 clients, a healthy mix of domestic institutional investors and FIIs. A lot of meetings have been packed to the hilt, and we've been forced to bring in extra chairs to make sure people get a chance to hear corporates. Some of the really popular sessions which we have on the main track are basically, we had a panel discussion on data centers, which was extremely well attended. We had a renewable discussion. We had a discussion on private equity. We had a private equity panel. We also had Toyota Kirloskar talking about how the auto market and how India is expected to do over the next 10 to 15 years. That was super interesting. We had the CFO of Eternal in our conference talking about quick commerce and food delivery and their new business of District, which is basically events. So that was totally packed. So a lot of different things. We also had a couple of people on the electronic side. We had NXP Semiconductors, we had Bhagwati Electronics. So a lot of interest there. Most investors have come, they have evaluated. Everybody believes in the long-term structural growth story of India. The only problem at this point in time is the fact that India markets are expensive. So it is very hard to justify the fact that you should be buying immediately. So what most people are doing is they are meeting corporates, they are looking at what stocks they like, what are the stories which are working out, and they are possibly waiting for an opportune moment to buy it. Maybe if there is a short correction, you will start seeing buying happening once again.
And then also from a valuation perspective, any sector that you find particularly value in?
Like, to be brutally frank with you, the whole of India is super expensive. The only pocket of value which is there is maybe private sector banks which are trading in line with historical mean, and maybe government banks are trading one standard deviation below mean. Everything else is trading either one standard deviation above or maybe even 1.5 and 2 standard deviation above. So it's very difficult to justify most of the stocks in the Indian market when it comes to valuations. You can justify banks, private sector banks and government banks. The problem is that problem in the current year for that sector has been the lack of EPS growth. So according to me, once EPS growth is back in that sector, you get double-digit kind of EPS growth, which we hope will happen next year. You will see banks and financials performing phenomenally. And please remember, the largest holding for FIIs are in banks. So 30% of their holdings are in banks and financials. They have been sellers in that sector for the last 2 years almost. If that changes, once growth comes through, valuation is well set, not only will the banks and financials perform well, the entire Nifty will start performing well. But for that, banks and financials need to work as a trade.
And how soon do you think, Venkatesh, will FII start buying into the Indian equity market? Because from a valuation standpoint, India still looks expensive, as you said, and just mentioned.
So that is what ideally what should have happened is when the FIIs were selling, the market should have corrected much more. So that is called a cleansing. When the market becomes very expensive and when somebody sells, the markets are supposed to correct so that valuations revert back to mean. But unfortunately, given the domestic flows, I wouldn't call it unfortunately. For whatever reason, the domestic flows are so strong that it is absorbing anything and everything that the FIIs are selling. So the markets are not mean reverting. And that has been the issue. Now, incidentally, if I can highlight a few data points, I think year to date, India has seen roughly $24 billion of net outflows when it comes to equities in the secondary market. But FIs have definitely brought in money when there are IPOs. So in the primary market, we have seen almost $7 to $8 billion of flows. So whenever a large cap or slightly larger mid cap has come out for an IPO and the valuations have been reasonable, FIs have bought. So it's not like the FIs are completely shunning the market. If they have a good quality idea at the right valuations, they are buying. But if the markets are expensive, they are selling. Incidentally, a lot of that flow has gone into China. So if you look at August and September, China has seen almost $70 billion of inflows. So you need to give the market, you need to give investors the right valuations and the right ideas. Unfortunately, those are few and far between today.
That was V. Balasubramanian, MD and Head of Research, JM Financial Institutions, speaking about how the shifting geopolitical landscape is impacting the India market and especially the Indian equities valued as compared to the emerging market peers. Now, moving on. It was a weak day of trade on Dalal Street today amidst heightened volatility, but on a weekly basis, benchmarks managed to hold on to the gains. Now, Nifty ends gains for second straight week, while Nifty Bank's winning momentum continues for third week. Broader markets, however, raised their last week's gains as small caps ended the week with over 2% cut, while mid caps also ended with near 1% cut. Now, sectorally speaking, strong buying was seen in IT and auto stocks this week, while metals and energy stocks were the top laggards for the week.
Well, yes, turned out to be a good week for Indian equity markets, although we did see some bit of correction in Friday's trade. For the week gone by, Nifty ended with an uptick. In fact, we ended comfortably above that 26,000 mark this week, so clearly turned out to be a good week. As far as Nifty Bank is concerned, this index, remember, was gaining for the fourth consecutive week, and AU Small Finance Bank and some other stocks, the likes of Federal Bank, were also amongst the top gainers from the Nifty Banking Index. So yes, broader markets, however, were under quite a bit of pressure. In fact, Nifty Small Cap Index ended with a downtick of nearly 2.5%. Nifty Mid Cap Index also down 0.8% this week. So turned out to be a weak week for the broader markets. And in terms of individual sectors, we had a Nifty Auto Index, which was bucking the trend. That one was up 1% this week. On the losing side, though, Nifty banking stocks were under pressure, but we also had PSU banking stocks that were under pressure. Metal stocks, in fact, Nifty Metal Index was down 3.5% this week. That's the kind of carnage we saw in the metal index. But for the broader markets, they were under pressure, and Nifty ended above that 26,000 mark this week.
That was Ashesha giving us a roundup and highlights of the D Street performance for this week. Well, it is now time for a short break on Business at 9. See you after a short break. Welcome back. You're watching Business at 9. I'm Shibani Gharat. Now, in a welcome move for many consumers, IRDAI warns insurers against publishing misleading claim settlement ads and says that the companies must stop using inflated claim data. The regulator emphasizes on the need for awareness about the real performance of the insurers. My colleague Anurag Shah is here with more details. Anurag, over to you.
Insurance regulator IRDA has warned insurance companies about not to publish misleading claim settlement ads because as per IRDA, during the annual report, the claim settlement data is different, and in the various advertisement, the claim settlement numbers are completely different and inflated and misleading for policyholders. So in a circular sent by regulator to insurance companies and insurance council, IRDA has asked industry to create one standard formula for claim settlement disclosures. So customers should understand the real performance of each company that has been mentioned in the circular. As per IRDA, customer deserves clear, simple and honest information, and companies must ensure that ads are accurate, transparent and not misleading. So going ahead, all insurance companies will have one standard formula for claim settlement ratio. So proposed standard formula is to develop a robust formula that incorporate count of claims paid, count of claims closed without payment, count of claims repudiated and counts of claim outstanding, categorized with more than 30 days and less than 90 days. So that has also been suggested by regulator. A multiple ratio definition is also proposed to set a standard ratio like overall settlement ratio, net settlement ratio, efficiency ratio, which should be time based, that together provides a complete picture. So IRD has asked, after there were multiple claims by insurance companies of highest claim settlement, so going ahead there will be a standard disclosure by all insurance companies on the claim settlement.
Now, we are clearly all proud of what UPI has done for India and how well it is penetrated across the country. Now, RBI has issued a statement on UPI, India's popular mobile payment system. UPI will now be interlinked with the European real-time instant payment system TIPS, which is Target Instant Payment Settlement. My colleague Anurag Joshi joins in with more details.
The Reserve Bank of India and the European Central Bank have began the preparations to link UPI with Europe's payment system TIPS. TIPS is the Target Instant Payment System, and it's Eurozone's real-time instant payment system. Now the move will allow UPI and TIPS interlinking to enable cross-border remittances between India and the Eurozone. And the move aligns with the G20 roadmap to make remittances cheaper, faster, and more transparent. RBI and NIPL have engaged with the European Central Bank to operationalize the UPI and TIPS link. And the technical integration and risk management and settlement arrangements are currently underway. The proposed link is expected to benefit users from both the jurisdiction, which is India, and also the Eurozone area. The UPI push strengthens India's global payment connectivity strategy and also aligns with the India, Middle East and EU strategy, which was propounded during the summit in New Delhi in 2023.
Now, in one of the biggest workforce reforms, 4 new labour codes come into effect starting today. Now, new labour codes introduce reforms benefiting specially gig and platform workers, MSME and women employees. Sameer Dikshit is joining in with more details.
The centre has officially implemented the 4 new labour codes which will come into effect from Friday 21st of November 2025, and the new 4 labour codes will replace the 29 existing labour norms. Now this particular labour code was passed by the Parliament in year 2020, and after 5 years it has now been officially rolled out or implemented. Now Prime Minister Modi has also hailed this landmark reform for the labour segment and has mentioned that this is going to be one of the biggest reforms since independence, aiming to modernize as well as to bring much more transparency in the labour governance. When it comes to the 4 labour code, it includes Code on Wages 2019, the second one is Industrial Relations Code 2020, the third is Code on Social Security 2020, and the fourth one is Occupational Safety, Health and Working Condition Code 2020. So these are the 4 codes which will come into effect. When it comes to that, what key significant changes it will bring to the worker side. So first one is that it will provide universal social security, especially to the gig workers. For example, the PF, EAS, IC, the insurance, these sort of social security will be provided, and it will cover all the laborers, especially the gig workers. In addition to this, the aggregators, they must now have to contribute 1 to 2% of their fund as a welfare fund, which will help the laborers. In addition to this, mandatory appointment letter has to be given to the labor, and that will be this is not a choice but a mandatory clause that will come into effect, and this will help to ensure the transparency. Minimum wages for all, especially for women, the minimum wage criteria will be fixed, and it will be equivalent for both men and women labor as well. Timely wages is another important aspect. So wages, the dispersal has to be done timely, and it will be equal for all the segment. Health benefits, for example, free annual health checkup, which is going to be mandatory for the workers above the age of 40. So that sort of social security and the health benefit, it is being aimed to provide to the workers. Now for the employers or for the industry side, they have to reduce the compliance for the workers. They have to be more transparent. Whatever the norms are being included, it has to be conveyed to them and apprised to the government as well. The dispute resolution mechanism has to be made more robust, and it should be much more transparent as well. Fixed term employees are now entitled to the same benefits as a permanent staff. Whatever benefit it is being given to the permanent staff, the same has to be given to the fixed term employees as well. Now this particular labor reform is aimed to bring much more benefit to the gig economy, to the gig workers, also to the MSME sector and to the contractual labor. And government understands that this will be hailed as one of the biggest reforms since independence and will help to boost the country's economy as well.
Moving on, Grow remains upbeat after a strong sequential performance. Ishika joins in with earning fine print.
Sure. So Grow was up almost 5 or 6% after its Q2 results posted today. Now its market cap is back above 1 lakh crore after reporting a revenue of 1,020 crores this quarter, which is up 13% quarter on quarter. And its PAT and EBITDA are also both up 25%, whereas its EBITDA margin has also expanded to 59.3% from 53.4% quarter on quarter. Furthermore, it reported an AUM of 2.7 trillion or 2.7 lakh crores, up 2% quarter on quarter and 33% year on year. Furthermore, it reported that 19 million transacting users were there, up 5% quarter on quarter. It also mentioned that NSE active clients' market share has increased to 26.3% from 25.5% year on year. Now, the last note is that 4.5% of the 13% incremental revenue of Grow has been contributed by new users. So this result performance was a relief for Grow investors who saw a fall in share prices this week.
And then Prime Minister Narendra Modi has landed in Johannesburg today to attend the G20 Leaders Summit. He received a ceremonial welcome following his arrival at the Air Force Base Waterkloof in Pretoria. The Prime Minister is expected to discuss key issues concerning India and the Global South during the visit. This visit to South Africa will be PM Modi's fourth, following his bilateral visit in 2016 and his attendance at the two BRICS Summit in 2018 and 2023. This summit is the fourth consecutive G20 meeting hosted by the Global South, and it is particularly significant because India under PM Modi's leadership, in fact, had spearheaded all the efforts that led African Union to join the G20, an achievement which is, almost deemed as a landmark during India's G20 presidency in 2023. There will be several things discussed. Global key issues will be discussed at this summit. The summit's theme, in fact, this year is solidarity, equality and sustainability. And PM Modi is here to speak primarily on 3 sessions, which include economic growth, climate resilience and artificial intelligence. With that, it's a wrap on the show. Goodbye. Hope you all have a great weekend.